Have you ever wondered, how are Bursa Malaysia's marketplace being monitored? Would you like to know how the marketplace is maintained orderly and fair? Welcome to Bursa Malaysia. We are the frontline regulator of the equity and derivatives markets. So, what does this mean for you? Through Bursa Malaysia regulation, we ensure the markets you invest in are orderly and fair, so that you have timely, accurate, and complete information to make informed investment decisions. Are able to trade in a fair and efficient environment. Have confidence in your brokers to provide secure and trusted services to you. So, how do we protect the marketplace? We have multidisciplinary teams in Bursa Malaysia regulation that focus on specific areas while collaborating with each other to provide a comprehensive network of safeguards for investor protection. We also work closely with other regulators and law enforcement agencies. Real-time surveillance of the market. We have a market surveillance team that acts as your market police. They monitor the stock market against irregular trading activities in day-to-day trading. This team uses an automated surveillance system to monitor trading in the equity and derivatives markets in real time. Should irregular trading activities be detected, this team of specialized analysts will fact-check and engage the brokers involved for their immediate action. Supervision of intermediaries. As safeguarding the integrity of the marketplace is paramount to us, our intermediary supervision team secures the protection of your trading and deposits through consistent broker monitoring and inspection. Disclosure. Continuing listing obligations and gatekeeping of listed companies or products. To be ASEAN's leading, sustainable, and globally connected marketplace, Bursa Malaysia places high emphasis on the quality of our listed companies. This begins from the approving of new listings on the exchange, through to ensuring that listed companies remain of quality through governance and compliance. As it is imperative for investors to be well informed in the fast-paced financial world, Bursa Malaysia regulations listing and corporate surveillance teams monitor companies' corporate announcements so that they are disseminated to you in a timely and accurate manner. Enforcement action is taken should there be any failure to do so, or should there be any material inaccuracies to the announcements made. As we are also a venue for listed companies' secondary fundraising, our relevant departments work together to ensure investors' funds are always used as mandated. We have a dedicated team of finance experts to examine corporate disclosures, including financial reports, so that they are accurate and timely that you can rely on. Within Bursa Malaysia regulation, we have subject matter experts that look at the various international sustainability reporting frameworks that are constantly evolving to ensure that our disclosure requirements are appropriately benchmarked. This ultimately drives the desired improvements in our PLC sustainability disclosures as well as practices. Taking enforcement action. So what happens when the persons are regulated by us? Be they brokers, advisors, listed companies, directors, or their representatives, breach our rules. Appropriate action will be taken against them. The types of action taken would depend on the severity of the breach. Suspected breaches will be investigated, and enforcement actions will be taken if the breach is proven. Our enforcement proceedings and actions are consistent and fair as cases are discussed in a robust manner through our regulatory committees, comprising independent individuals with relevant experience and backgrounds. Policy and rulemaking. Bursa regulation is the guardian to the 10 rule books of the securities and derivatives markets. Rules drawn up by the regulatory policy and advisory team are always outcome-focused. Industry or public consultations with the relevant key stakeholders will be undertaken, alongside rigorous benchmarking processes to ensure the rules are relevant, effective, fit for purpose, and on par with international standards. Each multidisciplinary team in Bursa Malaysia regulation is intertwined and interact proactively to ensure high standards in market integrity.
So, all right. Shall I start now? Okay. So, hi everyone. Welcome to the webinar brought to you by Bursa Malaysia and managed by LiveChat. So my name is Alia, and I'll be the moderator for today's session. So our title today is a top 5 rookie mistake on stock investing, and how to overcome them. So investing, in stock is an exciting journey, but let's be honest, it can feel overwhelming when you are just starting out. So have you ever wondered why some beginners navigate the market with ease, while others struggle to get the profit? So the stock market is full of opportunities, but it also hides pitfalls that can trip up even the most enthusiastic newcomer. So today, we are honored to have Mr. Ian Tai to share his expertise on how to interpret financial statement. So before we start, I would like to allow me to make a short disclaimer. Please be reminded that everything that shared in this session is mainly for educational purpose, and by no way we are providing you advice to buy or sell any securities. So you are 100% liable if you make any investment decision. Okay, next I will allow me to briefly introduce our speaker, and he is not other than Mr. Ian Tai itself. So Mr. Ian Tai is a dividend investor and a financial content producer. So he produced 450 plus financial article features in kclaw.com in Malaysia, and the fifth person. So Value Invest Asia and a Small Cap Asia in Singapore. He is a regular host and presenter of a weekly financial webinar with kclaw.com. Ian co-founded dividendvault.com, an online membership site that empowers retail investor to build dividend portfolio independently via education. So please welcome Mr. Ian Tai. Hi, and how are you, Mr. Ian?
Hello, Alia. Hello,
Hi.
everyone. Good evening to all of you guys. And thank you so much, LiveChamp, and as well as Bersama Malaysia for organizing this. And it's also good to be back here to actually present my ideas, all right? Share with you my journey, my expertise with you guys when it comes to investing. So without further ado, let me just share with you my screen so that we can actually get started. All right. So by the way, along the way, if you have any questions, feel free to just post your questions in the Q&A box. I'll be more than happy to interact with you and answer some of your questions. Okay, so with that, let's get going. So on a monthly basis, I will be doing some sort of accounting, bookkeeping on my portfolio. So it's a monthly chore for me to do that. And so what I'm going to do here is that I'm going to just give you a breakdown, a simple breakdown of my current stock portfolio. So this is for December 2024. And here we have a donut chart where I'm going to just share with you how the weightage looks like when it comes to my portfolio. So currently the portfolio size is 6 figures, annual dividend income 5 figures. And when it comes to the geographical breakdown, Malaysia, which means to say stocks listed on Bursa Malaysia, accounts for 20% of my stock portfolio. Singapore, 74.4%, and US is about 5.5%. And if you look to the right-hand side of the screen, based on the donut chart, so these are my top 5 holdings. My top 5 holdings would be stock A, B, C, D, E. All right. And if you can look at the biggest when it comes to my stock holdings, the largest holding that I have, which is stock A, accounts for 15.7% of my portfolio. Second place will be stock B, 13.8, 11.9, 7.7, and 7.5. The remaining probably around 10 or 11 stocks that I own currently, they accounted for 43.3% of my portfolio. Okay, so this is my current status of my stock portfolio. And let's move on to the next part, which I think is more important than the snapshot of my own stock portfolio, which is to share with you guys how I personally view investing so that you guys get the context of who am I as an investor, what I do when it comes to building my own portfolio, my journey, my experiences, my expertise. And from there, hopefully you get to know me a little bit better. And if you find that anything that I have actually mentioned or shared with you guys today, if you find them to be useful, then you can actually adopt them and use them in your building of your own stock portfolio. So the first question that I would like to share with you is, how do I personally view investing? So to me, I like to see myself as a banker. So to me, investing is a bit like lending money. Okay, so I treat them the same. All right. So I like to imagine myself to be a banker, whereby I view stocks like my potential borrowers. All right. So imagine we have these three photos over here. So let's say this is stock A, this is stock B, this is stock C. So the question is that how do I actually pick the right stock? How do I actually, maybe that's the first question, right? How do you pick the right stock? Of course, there are many more questions along the way. Like for example, it's not just about picking the right stock, but also what price is a will be a good price, will be an ideal price to actually buy them. How long is my holding period? Usually my holding period is actually forever. And there are many more questions along the way. But here, I just want to actually like introduce myself and just share with you guys how do I actually look at stocks lah. All right. So imagine myself as a banker, and stocks are like this bunch of people. So this could be my potential borrowers. All right. So I use them interchangeably, stocks, borrowers, all right, and myself, banker or investor, in the same category. So let's assume that I'm the banker here. Okay, let's put aside the investor kind of character. Let's just borrow the banker's hat for a moment. So let's say I'm a banker, and let's say that we have customer A, customer B, and customer C walk into my bank branch lah. All right. So the question is, whose loan application should I approve? And what is the basis for me to approve or reject their loan applications? So that's the question that I would like to ask myself lah. And so obviously, for me personally, I have actually experienced, let's say, purchasing a house. So when you purchase a house, if you you don't have enough cash to buy the entire property, most likely you will go to the bank to ask for a loan, ask for a mortgage. So coming from the experience of someone who is borrowing from the bank, the banker will actually ask me, now the potential borrower, to actually provide them with the following documents, like my IC, bank, EPF statement, my income tax statement, whatever debt statements, whatever previous debts that I owe, I have to submit to them. They will probably buy my CCRIS and CTOS, and maybe they will actually ask for other relevant documentation so that they can do or they can perform a credit assessment on me as a potential borrower. So why does the bank do credit assessment? Why do they actually want to assess my credit? So my rationale is that I believe the banks will want to know, who am I as a borrower? What's my purpose of borrowing? How much do I earn? And whether or not do I have the capacity to actually pay off the mortgage? And if I've owed any debt previously, how is my debt repayment behavior like? So all in all, what does a banker do? What does my banker want to know is that they want to know who I am, why I want to borrow, how much do I earn, and what's my behavior like when it comes to managing my finances, and more importantly, repaying debt. So from here, they can actually see that whether or not I am creditworthy enough for me to get the loan. If I'm creditworthy enough, then I will get the loan. The bank will approve my loan application. But if let's say the bank decided that, hey, this Ian is not so creditworthy lah, all right, maybe he's falling short in certain category over here, then the bank can choose to reject my loan application. Okay. So typically, this is a simple graph that depicts how the credit assessment works when it comes to a situation of lending, which is there's a banker and there's a borrower. So in this case, a bank may actually use this graph. I think it's quite generic, whereby any potential borrowers that walk into the bank, they will demand anyone, doesn't matter how they look like, whether they look smart like this, they look okay like this, or they didn't look so nice like this, doesn't matter how they look. All these potential borrowers have to provide their IC, bank statements, income tax statements, debt statements, CCRIs, CITOS, and other documents. From there, then they will measure the creditworthiness of these people. If creditworthy, approve. If not creditworthy, reject. It's as simple as that. Okay. So how does this apply to stocks? Well, it's actually the same process. So over here, instead of potential borrowers, now they are potential stocks. Okay. So I treat potential stocks like potential borrowers, whereby we have A Berhad, B Berhad, C Berhad, and 900 other stocks on Bursa Malaysia. There's so many stocks to choose from just in Malaysia alone. So the question is, how do I know which is the kind of stock that I would prefer to invest? Well, so for me, I will have to do credit assessment. And based on how I build my portfolio, I will actually like to read their annual reports, quarterly reports. I will look through their announcements, press releases, and if these stocks actually prepare PPT, PowerPoint slides for their investors, then I will download them and I will just have a glance through of what they are presenting in their PPT. From these documents, I will actually assess whether or not they are creditworthy. This bunch of stocks, whether or not they are creditworthy. If they are creditworthy, great, I will kind of like consider an investment into them. If let's say they are not creditworthy, then I will totally dismiss these stocks. Okay, so which means to say, as long as the stock passes my test of creditworthiness, I will tend to put them in my watch list. But of course, there's another step whereby I have to perform valuation on it, like PE ratio, dividend yields, and all this kind of calculation. So once that I find that, hey, these stocks are attractively valued, then I will probably invest in them. Otherwise, I will still keep them in my watch list. So this is actually the mental block, the whole system, the structure that I have when it comes to building my portfolio. All right. So now, back to today's webinar, the topic, top five rookie mistakes that investors make. So the question is, among the top 5, what is the number 1 reason most investors lose money with stocks? So to me, the answer is actually quite simple lah. All right. All right. So personally, I believe that the number 1 reason why investors lose money in the stock market, lose money as an investor, is simply because there is a lack of credit assessments of these stocks before they invest, which means to say these investors, they do not have any sort of system, any sort of structure when it comes to credit assessment. Or you can say that they do not actually perform any sort of study, any sort of credit assessment before they choose and select the stock. And therefore, I believe that this is actually the first reason of why recurring losses can actually happen for people who are investing in the stock market, especially rookies. Okay. So why do I believe that this is actually the first reason why investors lose money in the stock market? Well, think of it this way. Let's imagine ourselves. Imagine that we have a banker, and this banker, right, he starts to lend money without doing any sort of credit assessment. So which means to say, let's assume that there's a banker. He is tasked to lend out money to people, but then he lends out money to people without doing any form of credit assessment. Like for example, when there's a customer walk into the bank, he doesn't require any sort of background checks. No need IC or whatsoever. No need to actually issue out no need to actually submit any sort of financial documents, credit card statements, EPF statements, penyata gaji, all these things, no need to submit. This banker also don't have any knowledge on the person's debt repayment history. All right. So without all this, how does he actually lend out money? Well, without all these documents, let's say this banker chooses to lend out money to his potential borrowers based on feelings and based on mood alone. Okay, so now my question is this. So assuming that we have a banker who does not require any sort of KYC, there's no financial documents submitted to him, there's no check on his debt repayment history, and he's just lending out money based on his feelings, based on his mood, or based on whether or not he likes the person. So participate with me here. The question is, will the bank have A, lots of profits from its lending activities, or B, lots of losses due to non-performing loans? This is a time where you can type in the chat box, let me know. What do you think will happen to the bank if a banker starts to lend out money based on mood, feelings, and no financial track record, nothing, no financial documents or whatsoever? What do you think? Okay, so we have Yang Chin Wei or Chin Wei Yang, B. Shahrash says bank bankrupt. Amirul says B. Jia Hong says B. Patrice, B. Okay, thank you so much. Yep, so it's true enough. If a bank, okay, imagine a banker who does that. Instead of having lots of profits from its lending activities, the bank may risk itself from incurring lots of losses due to non-performing loans. Okay, because there's no KYC, there's no background check or whatsoever. So when you don't actually do your studies, when you don't actually do a check on your potential borrower, it is actually quite risky to invest. It is actually quite risky for the bank to lend out money to these people. Okay. So likewise, if you put yourself in the investor's position, there are many people who say that investing is risky. So I always wonder why. Why is investing risky? So when you talk to people and when you hear people, maybe we have just celebrated Chinese New Year, and maybe there are some people who's going to tell you, hey, investing is risky. So the question is always why? Why that statement? Why do people believe that investing is risky? What got them to think of investing that way? So when you ask them the question, chances are, or most likely, you will find that the answer is actually pretty simple. The number one reason why people think that investing is risky is simply because they believe that, how do I say, the reason why investors believe that, why most of the investors believe that investing is risky is simply because they did not do enough study. They did not do their homework. They don't actually do credit assessment. 99%, or let me just reduce it a bit. Let's say 90% of the chance, most likely why investing is risky has to do with this reason. It's as simple as that. Okay. So like Eugene Wong has a comment, and he says that something is only risky if you do not know what you are doing. Your risk level depends on your level of knowledge. Correct. So in a way, it is true, because when you have actually done your homework, when you done your study, when you did enough, when you put in enough time and effort to actually go through the process of understanding your investments, chances are you can actually reduce your risk of making investing mistakes. And because of that, you will actually reduce significantly your non-performing investments. Okay. Now, let me just ask you another question. Okay. So now here's another situation. So pay attention. Here's another question. Now imagine yourself a banker who lends money with credit assessment. So now let's say, for example, now you are who are listening to this webinar over here. Let's imagine that let's imagine yourself as a banker today. And you believe in lending money after you have done your credit assessment, which means to say you will do your KYC, know your customer, you will do background checks, you will ask for proof of financial records, and you have knowledge of the person's debt repayment history. And you use data to back up your reasoning for lending money to this pool of customers. And you are very data-driven, data-reliant, and because of that, you do not lend based on feeling, based on mood, or based on whether or not you like the person is not so important. It's all very data numbers driven. Okay, data numbers driven. As long as they hit your criteria, you lend. There's no feelings involved in this scenario. So in this case, my question is, could the bank or could you as a banker, number one, eliminate 100% risk of losses due to non-performing loans? And the second one would be, could the bank reduce the risk of losses due to non-performing loans? Type in your answer. Let me know what you guys think. Would it be option A or would it be option B? Just let me know. Okay, so we have Amirul Muslimin, who says we can kecilkan the risk. Okay, so we can reduce the risk by doing the assessment. So I will choose B. Okay. Lau Yok Eng, B. Chin Wei Yang, B. Okay, Eugene Wong, B. Nothing is ever certain. Only death and taxes are certain. All right, true. Okay, so most of you guys actually pick B as your preferred option. So likewise, I myself also included, I will pick B. Okay. So like in Malaysia, we have quite a number of listed banks. All of them perform credit assessment. Of course, certain banks are more conservative, certain banks are more aggressive, but you can say none of the banks in Malaysia can eliminate 100% risk of losses due to non-performing loans. Every single bank has some form of non-performing losses. It's just a matter of whether you have a lot of non-performing loans or whether you have lesser non-performing loans. But with credit assessment, there's one thing for sure, which is they can definitely reduce the risk of losses due to non-performing loans. Okay. And by doing this, by performing credit assessments, even for all the banks in Malaysia, they can pick their customers, they can pick the better quality customers, choose the one with better debt repayment behavior, choose the one that will more likely service their loan. And because of that, they earn billions in profits every single year. So if the bank is doing it, then I might as well just adopt their thinking, adopt their philosophy of running their loan portfolio and apply it to my own investment portfolio. So that's how I personally think when it comes to building my own portfolio. Okay. So I'm with most of you guys. I'll choose B. Okay. So which means if credit assessment is performed, it's not that we can eliminate 100% risk of losses. I do have my fair share of losses, but I definitely can say that if I don't do credit assessment, my portfolio will go haywire. But because of credit assessment, I can actually reduce the risk of losses, and I don't really have a lot of non-performing investments. All right, you can actually increase your proportion, let's say this is your number of investments. If you do credit assessment, you can actually increase or improve the investment performance, or you can say the investment results of the stocks that you pick lah. All right. So it's important to do credit assessment. So with credit assessment, I believe that investing can be less risky. Now, the question is, how do I assess a stock's creditworthiness? Okay, so guys, you can actually type in the chat box. What do you think I'll be looking at as an investor on how do you think that I would choose which stocks are creditworthy, which stocks are not creditworthy? Type in the chat box. Let me know which angle do you think that I will be looking at. Okay, so let me just read it out to you guys, the comments at the webinar chat. So Eugene Wong says, stable and consistent cash flow. Yes, definitely I'll be looking at stable and the stability and consistency of the cash flow. So to me, I will look at two things when it comes to cash flow. The first one would be operating cash flow. Okay, because I believe that operating cash flow is the hallmark of success when it comes to running a business. So if a business can generate consistent growth in operating cash flow, it means that it can consistently generate cash from its customers. Okay, so nothing is more sweeter than to find a stock that can actually generate consistent growth in operating cash flow. So yes, Eugene, correct. That's one of the main criteria of how I look at stock's creditworthiness. Correct. But on top of the operating cash flow, I also want to know how the stock allocates its capital. So to me, here's how I look at things when it comes to cash flow. Number one, I want to know whether or not the company or the business that I'm going to invest into can generate consistent growth in operating cash flow. So that's cash in. Now, cash come in, how does the company actually allocate its cash flow? So that one I'll be looking at several ways of how the company can allocate its capital. It could actually spend money on capex. It could spend money on R&D activities. It could spend money on business acquisitions, buying out its suppliers, distributors, its competition, and maybe even invest in any other companies which are not related to its own industry also can. Maybe it can choose to do share buybacks. Maybe it can pay out dividends to people. So I just want to know what will the company do when it comes to its capital raise? All right. So from there, I understand the company culture of the business, of the company. Okay. So stable and consistent cash flow, yes. Shahras Warren, so profitability, yes. So I'll be looking at that. And Yu Xiu Feng, yes, consistent profit generated. So good. And we have Lau Yok Eng, PE ratio, dividend yield. So these two are valuation ratios. And that one is, here's how I look at things, Lau. Like for example, let's say I have a stock. I don't look at the stock's PE ratio first. I don't look at its dividend yield. That one later on. What I will do first is that I will check the stock's creditworthiness. In other words, its fundamental quality. I want to check whether or not the company is financially stable. I want to know whether the company has a track record of generating consistent growth in sales, profits, operating cash flow, how it allocates its capital. I want to know the culture first. I want to know how the business can generate sustainable growth or sustainable or consistent growth in profits and operating cash flow first. Only then, if I'm satisfied with the creditworthiness portion, then only I move on to valuation, which is the PE ratio and dividend yields. Nazrin, Aminuddin, EBITDA. Okay, so guys, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's an accounting term, but I don't use it lah. Okay, I guess different industries will use EBITDA very differently. But personally, do I use it? I don't use it. But with that being said, if let's say you have been using EBITDA for quite some time and you find that to be useful, I don't mind lah. I think it's still okay to actually calculate the EBITDA. It's just that for me, I didn't really calculate a stock's EBITDA and compare it with its previous years just to find out whether or not the stock is creditworthy. But if you have a habit of doing so, and you find that EBITDA is actually something that you want to calculate before you put your money into the stock, why not, right? So you can actually do EBITDA, no worries. Okay, so with that, let's move on. Okay, so this is actually what I'll be looking at. I'll just read it out. So the first thing that I want to know is that I want to know how the business make money. So which means to say I want to know the business model of the company. Then the next thing is that if I understand the business model, I want to see whether or not the company has generated consistent growth in earnings in the past 10 years. Okay. Then subsequently, I want to know, it's not enough for me to know the company's profitability or earnings. What's more important than the profitability and earnings is the operating cash flow. Why? Simply because there are certain companies, especially the ones that don't do cash sales. Okay, so let me just detour a little bit. So there are cash sales, there are credit sales. Cash sales are businesses whereby, like, for example, like restaurants or cafes. Like you go to a cafe, you order a latte, and then you pay for it, collect your drink, enjoy your drink, and that's it. So there's no hutang here. There's no customer owing the business because you have to pay first to get your latte or any drink that you order. Or maybe you order your drink first, but then after you have consumed your drink, you have to go to the cashier counter and make your payment. So there's no hutang over here. There's no owing. But there are companies who do credit sales. Credit sales simply means, let's say I'm a company that engages in several projects. All right. And I would like to engage you as my customer. So the thing is that I can do the project first and I will bill you, but I'll give you a credit term of, let's say, 60 days or 90 days. So that is credit sales. So there are two different kinds of sales. So personally, I will prefer cash sales more than credit sales. It's not to say I will dismiss credit sales totally, but if a company does credit sales, I also want to make sure that this company is very good in cash collection. Okay. So if let's say the company is doing projects, not so good in cash collection, then I think I will tend to avoid these kind of companies. Because these kind of companies usually, when it comes to operating cash flow, they can't actually generate positive operating cash flow consistently. If they can't do that, then there's no bother measuring whether they can generate operating cash flow, increasing operating cash flow on a consistent basis. No point already. Okay. Now next, I want to know how it allocates its capital. And last but not least, this is actually more for defensive because we are investing in a time where there is a lot of volatility, there's a lot of uncertainty in the markets, in the economy and all this. So I just want to make sure that the company that I invest in, right, they have a culture of maintaining a strong balance sheet. Strong balance sheet simply means that they have liquidity, number one, which means liquidity simply means emergency fund. I want to see whether the company has enough emergency fund so that if, let's say, there's a crisis like COVID-19, for instance, or an economic crisis, they have the funds to sustain. They have the funds to tahan through the tough times. Another way to look at balance sheet is debt. The company that I invested in, I hope that they don't actually have too much debt. It's okay to have debt, but I always measure debt with the company's operating cash flow. So it's kind of like it's kind of like a bank measuring a borrower's potential debt servicing ratio before they approve or reject a loan. So I also measure that on stocks. So usually I would prefer a stock whereby their debt levels are lower in comparison to their operating cash flow. Okay, so these are the stuff that I will be looking at. All right. So we have a comment that says, what about free cash flow? Free cash flow is good. Okay. Usually how I will there are quite a number of ways, I believe, to calculate free cash flow. So the thing is that I will take the company's operating cash flow and I will minus off capital expenditure. It's the fastest way lah. I wouldn't say it's the most accurate way, but it is actually the fastest way that I can come up with lah when it comes to calculating a stock's free cash flow. So if a stock can actually generate consistent growth, not just in operating cash flow, but also free cash flow, wow. It's like this stock, right? It's like someone who is earning, I'm just giving an analogy. Let's say, for example, this guy, he is earning 10,000 ringgit. And then after he has done his capital expenditure and all the operating expenses, he's left with 5,000 every month. What can he do with the 5,000? Well, that's free cash flow lah, all right? Free cash flow is, why is it called free? It's simply because the company can use this cash flow freely to do whatever they can do to maximize the benefit of their shareholders. Free cash flow can be used for business acquisition, share buybacks. If they got nothing better to do, they'll take this free cash flow and pay out dividends to shareholders. Of course, there's another option where the company can choose to use the free cash flow. They can choose to use the free cash flow to pay off some debt lah. They can do that. But of course, if let's say you are finding a company whereby their balance sheet is not so, they don't have too much debt lah in the first place, right? Then they don't have much debt to pay anyway. So when that happens, well, they might as well either use it to expand the business or they pay out dividends to their shareholders. Okay, but anyway, these are the stuff that I will be looking at when it comes to assessing a stock's creditworthiness. Now, coming back to my portfolio. So this is my portfolio. So I have highlighted stock A, B, C, D, E. So I'm going to just give you a summary of how their earnings, how did they perform when it comes to their income productivity. Okay, so let's start with stock A. So this is how it looks like when it comes to their income productivity. So as you can see, if I plot a bar chart, when it comes to stock A's earnings, it is actually pretty much straightforward. It grows, but over here gives some leeway because there is COVID-19. But even even during crisis times, right? It will be a plus point to me if let's say during COVID times when there's so many challenges in the economy at that point in time, the business is still profitable. That is actually another plus point to me. Because there are companies where you can actually make profits during okay business environment, okay business times, but during COVID-19, bam, from profits to losses. Some industries is inevitable. It's very unfortunate. That one, I understand. But if let's say a business can still rake in profits, they can still generate profits despite operating in the most difficult situation, difficult circumstances, then that's a plus point. But over the long term, if you take a look at the company's earnings, I want a stock that is consistently growing its sales, its earnings, and operating cash flow. Its chart is going to only look something like this. So if you take a look at stock B, this is how stock B looks like when it comes to its earnings. So it is consistently growing. There's a leeway over here due to COVID. And after COVID, it has recovered back to pre-COVID levels. And then there's an increase in profitability. So this is how stock B looks like. Stock C is the same thing. consistent growth in profits. Stock D, it looks something like this. Pretty much the same pattern. And finally, we have stock E, also the same pattern. So, which means to say, when it comes to my portfolio, although I own different stocks, but there's a common ground, there's a common denominator that unites most of these companies that I own. And the common denominator for my own portfolio is this. I want stocks to report, to deliver profits, earnings, operating cash flow that look only like this, which means I don't have any other stocks, any other patterns of profitability. I only have this only in my portfolio. Okay, so when it comes to my investment journey, that is actually pretty consistent lah. So I tend to do this. So guys, of course, the topic of today's webinar is the top 5 rookie mistakes, right? I will be revealing to you what are the top 5. But here I spend most of my time talking about the first one, because if you can take care of the first one, a lot of things will be taken care of anyway. Okay. So to me, the best way for rookie investors to avoid any other kind of stocks, any other kind of investing mistakes, right, is to just do credit assessment. If you do credit assessment and you just focus on stocks like this, right, you will automatically reduce your chances of incurring unnecessary investing mistakes or losses. You'll reduce your risk by so much percent, by so much, by just doing this only. Okay. So once again, back to the common denominator of my own portfolio. As you can see, the top 5 stocks, and as well as many of my other stocks, I have about 15 or 16 stocks in my portfolio right now. Most of them look something like this. Okay. Now, I'm going to share with you another concept when it comes to avoiding investing mistakes. And hopefully, I feel that as a person who has actually journeyed along this way, journey as an investor, I feel that this is actually quite important. Especially if today, if you're listening to this webinar and you are new, you're aspiring investor, you are actually looking towards building a 6-figure portfolio, I believe that this concept or this story over here has some usefulness when it comes to helping you building your portfolio. So here, I'm going to just share with you why a tortoise can win the game of investing. So guys, I believe that you are very much familiar of the story, the tortoise and the hare, or the hare of the tortoise. Okay. So we have a hare, so we have an Arnab, and then we have the Kura, which is the tortoise. So the thing is that what I observe after years of investing is that there are many hares in the stock market. There are fewer tortoises in the stock market. So there are a lot of hares. A lot of people like to equate that investing is a very exciting journey. It's exciting. It's where you can actually make fast money. It's where you can make certain amount of money, not just small money, but big money in the short span of time. So this kind of like resembles the hare, the characteristics of a hare, whereby a lot of people come into the stock market, they are new, they are fresh, they are quite a rookie, and they really, really aspire that they can make, let's say, 20%, 30%, 50%, 100%, 200% in capital gains in the stock market. And they believe that capital gains is actually the way to go. It's the big money. dividend yield, small money, but capital gains, how you can 2x, 3x your money. That's the big money in the stock market. So they're aiming for that, but they're new. So when they're new, they do not know that they need to do credit assessment. Anyway, they don't have any credit assessment. So in order to actually get this big money, what most hair did is actually this. They believe in market timing, they want to trade, and they want to speculate. Because if they want to do credit assessment, it's some work. Can't really sugarcoat this. Sure, as most of us, we have a busy schedule, busy career, time with family, hobbies. All these are very understandable. But then when it comes to our investing journey, we just want a quick fix. We just want somebody to actually tell us, hey, maybe this is the stock that will give us the 30-50% capital gains or the 1x, 2x kind of capital returns. And they hope that they can actually do this instantaneously. So most of these hairs, right, what they will do is that they will actually try to board on the bullet train. And hopefully the bullet train will actually get them to where they want to be. Now, let's see the tortoise. So when it comes to the tortoise, investing is not so exciting anymore. It can be a rather boring process. Okay. Why is it boring? Because there's nothing exciting about an investor trying to take one step at a time. Okay, 1 foot here, 1 foot there, 1 foot here, 1 foot there. Making sensible decisions, not exciting, pretty boring. Generating regular dividends. Some of these stocks, maybe they are going to yield a 3%. Maybe they are going to give a 3% dividend yield. Maybe 4, maybe 5, sometimes 7% per annum in dividend yield. All right. 3, 5, 7% per annum in dividend yields. They come in. Initially, the cash flow is there. Not very exciting, but it's always recurring. It's regular, it's recurring, and over time it will increase. So usually this is actually for people who are into fundamental investing. It's boring. It's not rocket science. It's quite logical. It's not to say that you are super smart to actually attain or obtain a 3% dividend yield, 5% dividend yield from a stock. As long as you have good enough intelligence, you should be able to get that kind of returns from the stock market if you pick the right stock after you have done credit assessment. It's boring. The progression is slow. So especially for the hare, they will actually say that the tortoise is boarding the slow train. Okay? Initially, it seems that way. But why is it that somehow or rather, most of the hares over here didn't make it? But many of the tortoises over here, they can make it in investing. Guess what? Now, this is actually the flow of what happened to a hare. This could be the possible problems that hares are facing when it comes to building their portfolio. So this is how it works. For many hares, they may initially dream that, hey, one day I will hit 6 figures. But I want it fast. So I skip learning first. I start investing. Okay, so which means to say they are willing to invest, they are willing to put their money into the stock, but they skip learning. They don't want to learn. So when that happens, without a credit assessment, without any sort of system or structure, they tend to pick stocks where their fundamentals are actually quite questionable. So over time, sure, there are some instances where these hares can get lucky. It's called beginner's luck. They may actually get their 30%, 50% capital gains in a short period of time for their first few stocks. Beginner's luck. But if they do this long enough, eventually they will have to face this situation whereby share prices of the stocks that they pick actually come down. So when this happens, they tend to see that, oh, the market performance has changed. It has become bad. And when it becomes bad, they tend to lose confidence. And some of those people who equate net worth with self-worth, maybe they feel a little bit low in terms of self-esteem. And when they feel that they have lost their confidence, they lose their self-esteem, they tend to stop investing altogether. And because of that, their brokerage account were left idle. So when it comes to hares, this is how their psychological state, their thinking process, this is how they flow. They started fast. However, they did not actually achieve what they have aspired because because of the loss in confidence and the loss in self-esteem. So hopefully this does not happen to you. All right. Now, let's look at the tortoise and why is it possible that the tortoise could win? So the tortoise, they can also have the same dream of attaining 6 figures in their stock portfolio. But since they know that they're going to build something which is significant, like 6 figures or 7 figures, just like building a house, they want to make sure that the fundamentals are right. It's like, okay, I'm going to build a bungalow. It's time for me to first get an architect to draw out the plans. Okay, I want to make sure that I have a blueprint for my bungalow. I want to know how it's built, how it is going to be designed, what kind of materials and all this kind of stuff. Okay, so we started off with a dream, and then the tortoise will proceed to learn the fundamentals of investing. So after learning the fundamentals of investing, usually they will have a higher chance of picking or selecting stocks with solid fundamentals to invest. Now, for the tortoises, once they learn more about the fundamentals of investing, they are also aware that stocks in the short term are volatile. Some of them, they can go up, but there will be times where stocks can come down. But when stocks come down, hey, instead of looking at it as bad performances, they can actually see stocks whereby the stock price have actually fallen. They can actually look at it at the angle whereby, hey, some of these stocks could be attractively valued, measured in PE ratio and dividend yields. So because of this, they have more confidence to buy more of these stocks with solid fundamentals. And of course, with dividend yields coming in, they will tend to continue, stick in the game. They continue to invest their regular savings into the stock market. So this is consistent investing. So if you do it long enough, eventually the aspiration of having a 6-figure portfolio can be fulfilled. So you may start slow, you may have a slow start, but at the very least, you will hit the finishing line. So to me, and of course, we have my boss and some of my friends who are in the investing circle, most of them actually hit their first ever 6-figure portfolio through this way, which is the tortoise way. And I also learned that for many people who, after years of investing, they still fail to actually hit 6-figure. Why? Most of them, I'm not saying all of them, I'm just saying most of them. Most of them simply because they try to have a fast start, but once the party is over, once confidence is lost, they stop investing altogether. How long do they stop? They don't stop for 1 year or 2 years. It could be 3 years, it could be 5 years, it could be 10 years, it could be a lifetime. When confidence is lost, once they are hurt, once they feel the pain of losing money, they say, oh, stock investing is risky. Let's not invest in stocks. Then they're out of the game, and that's it. So the key thing here, if you happen to be a rookie, it's not so much about what stocks should I buy that will get me the best return. I believe that's not the right question to ask. To me, if you are dreaming about building a 6-figure portfolio, or maybe 7, you are now trying to hit 7, like me, for example, the way to get it there is just be consistent. For the first few years, just stay in the game. All right, just find a way for you to consistently invest, stay in the game. Sure, your returns may not be superb for the first 2 years. Even my track record for the first 2 years as an investor I wouldn't say it's that bad, but it's not the best. But it allows me to stay in the game. And with that, right, and that is very important, simply because my best returns occur after I have survived the first 2 or maybe 3 years of investing. Okay? So that is actually the way. The better stock returns always happen after you have survived the first 2 years of your investing journey. So if you're a rookie today, just find a way to survive your first 2 or 3 years. Probably your 4th year or 5th year, maybe that's where your bigger returns will actually start to kick in. So in other words, no need to go for fast gains lah. First 3 years, take it as a learning experience. Take it as a way for you to just learn about investing, learn more about yourself, be a better investor. I'm very sure by year 4, year 5, year 6, the returns will actually come in. All right. Now, this is actually the tortoise. If you like to be a tortoise, just like me, I'm a tortoise myself. I will consider myself as a tortoise, not a hare. So this is what I believe to be the winning toolbox to build a portfolio. So there are always 3 questions. All right, 3 simple questions. Number 1, what to buy or sell. Number 2, what price to buy or sell. And number 3, how much should I buy or sell? Many people say, what to buy? What to buy? What to buy is just one question. There are so many other questions to be answered. Okay. Usually I don't answer this kind of question. If people ask me, I don't really answer. All right. But if you want to know what to buy, so if you ask an investor, usually they will say stocks with solid fundamentals. So how do you know that this stock, the fundamental is solid? So you need certain skills to actually identify stocks that are fundamentally solid. And that skill is accounting. So which means you have to rely, like me, I rely a lot on my accounting skills in order to find out which stocks are actually better in terms of their fundamental quality. If they are not so good in terms of their fundamental quality, I will just dismiss it altogether. So what skills? Accounting. Number 2, just now we talked about the PE ratio and dividend yield. So that one will help me to determine what price should I pay for the stock or what price should I sell off the stock. But usually I don't really sell off the stock, okay? Usually I just buy and keep. But in order to find out the price, an ideal price or a reasonable price to pay for the stock, I will rely on skill number 2, which is valuation. So valuation is a skill set that I acquire to help me to decide when I should buy or when I should sell the stock, and as well as what price. Number 3, how much to buy? So you may buy a stock, a very good stock, but you only buy, the quantity that you buy is just, let's say, just 1% of your overall net worth. So even if that stock doubles in stock price, for instance, 1 ringgit becomes 2 ringgit or 10 ringgit becomes 20 ringgit. it's not going to have a substantial effect on your overall net worth. All right. So that is actually another classic example of portfolio management. Okay. So portfolio management is where it helps me or it guides me on how much should I actually pay? How much should I buy? Okay. Should I buy, let's say, just 100 units of that stock, 500 units, 1,000 units? How much of this stock should I own in my portfolio? So this one, I will have to rely on skill set number 3, which is portfolio management. So just now I talked about the weightage like this. So this is actually an example of portfolio management. So even though that I have done my homework on stock A, I did not actually build a portfolio out of just stock A lah. Some did and did very well, especially when, they just invested in one stock and that one stock is 100% of their portfolio and it did well. So if that's the case, that's one way of investing, but it's not my way of investing. For me, I tend to actually spread it out to maybe 15 to 20 stocks. Then from there, so Eugene says Sailang is haram. So Sailang is like all in into one stock. I would say it's haram lah, because some people actually did well with some people did well with just a one stock portfolio. I don't deny that. Okay, there are people who are doing okay with 2 stocks, 3 stocks in their portfolio and they did fabulously okay. So I'm not against that. It's just that when it comes to portfolio management, like how you want to determine how many stocks you want to have in your portfolio is an art. It's a matter of preference. You can have, like me, 15 to 20 stocks, but some people prefer to have only 5 to 10 stocks, and it's perfectly fine. There are investors who did well with just 5 stocks, and there are also investors who did well with 50 stocks. So who is to say which one is better? But it's just a matter of preference, which one you like to go with. All right. But if you're a beginner, just try out with 5 to 10 stocks. Make sure you do credit assessment and you pick the best from Bursa Malaysia. Okay. If you're investing in Malaysia. So now it's time for me to review to you the top 5 mistakes and how you can avoid them. So I believe that mistake number 1 is you skip learning and you start investing money. So this is actually a no-no because you need certain skills like accounting skills, valuation skills, and portfolio management skills to do well in investing. Out of these 3 skills, if you have none of the 3, start with accounting, then valuation. After you have acquired these 2 skills, you can start building a mini size portfolio. Then from there, you pick up portfolio management. Still okay. Mistake number 2, no credit assessment. This one is definitely a big no-no when it comes to investing, because the best stocks that give you the best returns, usually they are profitable. Usually their financial standing, their balance sheet is actually very strong, or you can say one of the strongest in the industry. So quite rugi lah if you don't do credit assessment. Mistake number 3, buy and sell stocks randomly and aimlessly. This one is definitely a no-go. If you want to build a 6-figure portfolio, at least you have to be intentional about the criteria of stocks that you want to include in your watch list and your portfolio. Mistake number 4, failure to be intentional on how you want to build a portfolio. So this one is definitely a no-go. It's good to be intentional, be purposeful when it comes to how you want to build your portfolio. And mistake number 5, not staying in the game. You fail to invest consistently. So this usually happens if you start investing, not learning, and then you fail, you give up. So try to make it a habit to invest consistently. Do postmortem, do reflect on your portfolio every now and then to become a better investor. Continue to learn, and I'm sure that you will get there. Okay. So to counter the 5 mistakes, here are the remedies. Remedy 1, start learning. Start learning first. It's okay to take 3 months, 6 months, or even a year to start learning first. Skip investing. Once you learn, the skills can actually apply it for life. It can be for 10, 20, 30, 40, or 50 years of your life. So spending 1 year of your time learning about investing is actually quite worth it. Remedy 2, perform credit assessment. Remedy 3, be purposeful. Remedy 4, be intentional on how you want to build a portfolio. Finally, the 5th remedy, invest consistently. So with that, I would like to thank you for your attention and your participation on this webinar. Hopefully you enjoy it and you gain some value out of it. With that, I'll pass the control back to Alia. Thank you, guys.
Um, can you unshare the slide?
Oh, unshare.
Yeah.
Sure. Hold on. Stop share. Okay.
Okay, sorry. Okay. For a while. Okay. So
Yep.
thank you, Mr. Ian Tai, for your invaluable insight and wonderful sharing with us earlier. So we will now proceed to the Q&A session, and I encourage all attendees to submit any question you may have in the Q&A box so that Mr. Ian can address to your question accordingly.
Mm-hmm. Yep.
Okay. All right, so we have a first question. So, here, interesting to look at your portfolio. Above 70% invest in Singapore compared to US. Any specific reason?
Okay. So 70% in Singapore is simply because number one is about familiarity. So once you have actually studied stocks in Malaysia, eventually you go to your neighbor and start studying other people's stocks lah. All right. And of course, there is a need. I feel that there's a need for me to actually diversify a little bit of my personal wealth into other currencies. So therefore, Singapore is a choice lah. Okay. Considering that most of us, if you're investing in Malay, let's say we look at it as a whole portfolio, not just stocks, but also real estate lah. Actually, we have a huge, if let's say you buy real estate, you will also have a huge chunk of your assets in Ringgit Malaysia. So why not we just actually spend a little bit of, why not we just allocate some of our personal wealth into other currencies lah. So that's my own belief lah. Okay. Not to say that Bursa Malaysia is not a good place to invest. It's a good place to invest. It's just that, so that's my reasoning lah. That's number one. But specifically to Singapore and US. Why is it Singapore more than US? It's simply because actually for me, I started off as a dividend investor. Of course, in Singapore, because of the tax policies in Singapore for dividend investors, it's much more favorable. There's no 30% withholding tax like investing in the US stock market, because dividends from US stocks, I will be subjected to a 30% withholding tax. So naturally, since I'm beginning from or as a dividend investor, so naturally my portfolio is of such lah. But of course, over time, I will evolve and I will want to have a fine balance between dividend and growth. So I also kind of like build a watch list on the US stock market. I just want to pick the stocks that I want to invest in and start building a US-based portfolio lah. But as you can see, it's just 5.5% simply because my evolution, my transformation is still ongoing, and I'm still continuing to learn, and hopefully I can mature lah and strike a balance between the two in the coming years lah. So you can say that I'm still moving on lah as an investor.
All right. So for the next question is, what is your maximum weightage allocated to a stock in your portfolio? So are you trying to spread out evenly in the portfolio?
Initially, when I was building my six-figure portfolio, I wasn't that intentional lah, because I felt that weightages is not so important if your portfolio is not of that sort of size lah. But once you have a six-figure portfolio, then the weightages actually come into play. So the maximum is around 15% based on my slides. Currently, like, it's about 15 or 16%. And when it comes to spreading out evenly, I don't try to make it like super evenly lah. Okay, but I would say that somewhere in between, I won't be so accurate like I need to be 15%. It doesn't work that way lah. But maybe somewhere in the range of 10-15%, I still think is fine lah.
All right. So, for the third question, so need your view. Okay, after COVID 19, saw CIMB versus
Mm-hmm.
PB and which stock to invest in. So, because CIMB did grow 300, but PB stopped at the almost same price.
Oh, so first and foremost, I want to find um when it comes to investing in a bank, I want a bank that is conservative because I'm a conservative person. So usually what I will do is that I will find out all the banks in Malaysia, like we have 8 listed banks, I will find out their non-performing loan ratio, because that's the measurement of who is actually a more conservative bank. Okay. So the one that is ranked among the lowest, I will be more interested to look at its profit. I will be more interested to invest in those which are more conservative. The ones which are of higher non-performing loan ratio, I would definitely not invest in it lah. So that's my first criteria, because I want to ensure that the quality of the borrowers in the loan portfolio is strong. I want good customers, okay? I want banks with good customers. That good customers are the one that pay up, okay? They service their mortgages, their car loans, or whatsoever. So that's the first criteria. Then the next one will be the income productivity, the profitability of the bank. So I want to see which one can deliver a better track record in terms of its earnings. So that's the second one. Okay. Then the third one, I want to see during COVID-19, when it's very, very challenging, what's the profitability of the bank at that point in time lah? And what is the impairment loss incurred during that point in time? So I will measure all the 8 banks, and then I will just see lah, oh, which one is actually more resilient. So it's the test of resilience that is something that I will actually do, rather than the stock price. The stock price comes later. Anyway, I don't also look at the stock price, because it's good to know that CIMB grow by 300%, but I'm not looking at stock price, because what matters more to me is the valuation. Okay. So if the valuation of a certain bank is actually pretty right, and I think it's conservative, fine, I will actually include it in my portfolio, regardless of how the price moves lah. So price movement is not so important to me lah. But rather, it is the long-term sustainability of the business, the resilience is actually far more important, because once I buy, it's not like I'm going to sell lah. Whether or not any of these banks hit, they can increase their stock price by so much in a short term, that one is not so much of my concern. So that's how I will approach this lah.
Okay, so next question is what is market prediction for this year despite volatility due to world issue?
World issues. Actually, Alia, I just want to ask you a question. Do you think the world, all right, which year can you name me lah? Which year can you name me that does not have any issue?
I also don't know about that.
Is it every year also uncertain? Correct or not?
Yeah, yeah.
It seems that way, right? Every year,
Yeah,
which year is certain? None, right?
no.
So which means to say, as an investor, we just embrace volatility lah. It's just whether or not whether you can make it a friend or whether is it gonna be your worst enemy. If you know how to do valuation, like PE ratio and dividend yield, volatility is gonna be your friend. But if you do not know how to do PE ratio and dividend yield, you do not know how to use it, then volatility can be a very bad enemy. So that's why you learn valuation. Okay, so with that, market prediction, is it necessary? That's the thing. Just like bank, I do not know whether bank has market prediction. I do not know. But when it comes to lending money to people, when it comes to the process of lending, I think they use credit. They use credit policies lah. They have credit policies. They have their own system lah on filtering out who are better quality borrowers and who are the worst kind of borrowers lah. Okay, the good ones, they pay no matter what, they will actually accept lah. Actually, for me, once you know how to do credit assessment, once you have studied the business model, the financial standings and all this kind of stuff, right? You don't really need market prediction lah. That's my belief lah. You don't really need market prediction. You don't need to find another guru or you don't need to find another forecaster to actually help you to predict what will be the next trend in the future. At least that's how I approach investing lah.
All right. So, and on the next question, which industry would be good for dividends for Singapore? Banks?
You can say that you can check out the track record of dividend payouts by banks, no problem. You can try out REITs, you can try out any other stocks. So I'm not so biased in terms of what industries. It's the business. At the end of the day, dividends come from profits, cash profits of a business. Cash profits come from operating income. Operating income come from gross profit. Gross profit come from revenue. Revenue come from customers. So at the end of the day, look at the source. If you want dividends, just look back up the source. And then from there, if you find that the track record is healthy, then by all means, you can actually consider that lah.
All right. So, next question is how do you handle your taxation by investing overseas? For example, Singapore and USA.
I don't think there's dividend tax for Singapore and because that's the policy lah. Maybe that's why for dividend investors, Singapore seems to be a heaven lah. But Malaysia is not that bad lah. Yes, there will be 2% dividend tax. There'll be 2% tax on dividend income. But that one is like unless, okay, so it depends on your tax situation lah. But let's assume that you have a 7-figure, unless you tell me that you have 100 million shares of public bank. Oh, then of course the 2% will be an issue lah. Then the 2% is like, oh, I don't see how you can, I do not know how you can maneuver it lah. You just have to pay starting from this year lah. But if you're starting off as a rookie, there's nothing to think about lah. If let's say you have a stock portfolio of 50,000 ringgit, 30,000, 20,000, then not so much of an issue lah when it comes to dividends lah. So for me, I don't think my portfolio is that big lah, like 100 million public bank shares to worry too much about tax at this point in time lah. So no issues.
All right. So, moving on to the next question.
Mhm.
Where and how to get these good stocks with acceptable valuation?
First, don't worry too much about valuation. Focus on fundamentals first. Once the fundamentals are there, then you start calculating the valuation. Where to find? Of course, it takes a bit of effort lah. You have to actually go to Bursa Malaysia website, download their annual reports, and have a look lah. Yeah. So from there, but if you want a 1-minute test, you can just download a few annual reports. All right. just download 10 years, and then from there you see the amount of profits. If you find that the profits are actually growing over the past 10 years, then you can actually put in more time to study these kind of companies. But if let's say you find a company where the earnings actually come down over the past 10 years, then you don't need to spend time on this kind of company. You move on to the next one.
All right. Next question is, what are the top 5 sectors to be included in the portfolio? Does it must have a sector?
I don't have a top 5 sectors. Okay. It's not like I'm more into what kind of businesses I want to own. So my metric is actually I want to, as long as the business I understand, I know that it's consistently delivering good growth in profits, cash flow, and all this kind of stuff, I'm happy. So I'm
Okay.
not very sector specific.
All right. So, on the next question, uh, he said that I agree with you on a certain points of view. However, you are so young. Why you are so conservative? Investing need to be brave sometimes. First, look at the market sentiments. Second, look at the sector. Third, look at the individual counters.
Mm. I am conservative because of my upbringing and my personal character is that way because my first introduction to stocks is actually from like family and friends and all this kind of stuff, family gatherings and I thought is that they are investing, they are big boys, they are you are telling each other stories about what stocks they have bought and all this kind of stuff. And the thing is that after that, I realized that they are actually speculating and not really investing anyway. And of course, it happened to my family whereby my dad actually invested money into the stock market and it didn't work well because of the Asian financial crisis and all this kind of stuff. So all these experiences add up. And because of that, I was actually brought up to think that, hey, this investing thing is actually quite risky. But over time, I have to actually overcome this mindset. I have to learn. I have to reprogram myself, and then I did not go in with a gusto So I go in actually quite timid, quite how I say. You can say the word kiasi lah. Kiasi simply means scared to lose lah. Okay, so because of that, I want to build a fortress I want to build something which is more sustainable and that kind of stuff So when I was new to the game, I was coming in with that approach and I think it works well with me. And because of that, also I stay on But of course, not everyone has the same experience, background, like what I have. Some of you guys are more aggressive. So when you're aggressive, I also know that there are certain people who are more aggressive and they did not actually. It's like it's like the hair It's like the Arnold. They start very fast, but then they did not continue after that And when they didn't continue after that, they lose years of dividends. They lose years of dividends because they stop. So I think that one quite rugi So the conservative way, try to you still work out of your comfort zone, but try to be conservative. Just stay in the game Just stay in the game and just make sure that you are investing sensibly. I think you still can get there Because in order to finish, you want to cross that finish line, you at least have to finish that whole stretch of the race first Not so much about who is number one in the race. At least you have to finish first That kind of philosophy.
Okay, since we do not have much time left, we will just take one more question. Can?
Okay.
All right.
Yeah.
So, how long you have been investing and what was the return?
Oh, Eugene. So Eugene has a comment. Let me just dig out his comment. Is it some? Okay, first and foremost, yeah, I look young. which is true lah. I'm still young. I'm in my mid-30s right now. Okay. I'm in my mid-30s. So I guess I have almost a decade lah. You can say my years of experience, my first stock until now would be 5 to 10 years lah. Okay. And then in terms of my CAGR, I didn't really calculate my CAGR, so I couldn't tell you at this point. Okay. So I don't have a figure for you when it comes to CAGR at this point. But in terms of dividend yield, I would say that currently my highest will be above 10%. Why is it above 10? Simply because um, above 10% in dividend yield only are not capital gains. Simply because I bought it during COVID-19, and then the profits recovered, and then it grew further in terms of its profits. The more profits it made, the more dividends I get. So that's how the dividends actually came in. My lowest dividend yield probably less than 5%. Somewhere, if I can recall, I couldn't give you a number, but let's say just 4% lah. So it's within that range in terms of dividend yield. Capital gains, it can range. Some are okay, some are not. Some are doing okay, some are not. Some, I guess there is some capital losses here and there lah. But overall, how much in terms of CAGR, I don't know. Because I have 15 portfolio, unless the way to calculate is unless I take 15 stocks, I actually listed down when exactly I get my dividends, which is a lot, which is a lot of transaction, which is a lot of Excel work. And then from there, I use the XIRR calculator to calculate all these things. Then maybe I can get you the CAGR lah, which is not going to happen because we don't have a lot of time.
All right. End of the Q&A session. Okay. We would like to sincerely thank Mr. Ian for taking the time to respond to the question asked. And I hope that all of you have an accurate, new, and useful knowledge from this session. May this insight shared today prove to be advantageous in your investment and trading pursuit.
All right. Thank you so
All
much,
right.
Alia.
All right. Welcome. Okay, wait for a while.